Bala, Indian markets are up about 18% this year. How much of this year's rally is a function of global liquidity, and how much of this year's market rally is a function of pre-budget buying?
Yeah, I think as you rightly put it, the Jan till today, I think came as a big surprise for the markets, thanks to the LTRO when it came in. A lot of the global liquidity which was waiting in the pipeline to be invested in equity and suddenly came into the emerging market. And India also was fortunate enough to attract a large flow of money, which has never happened actually in the last many years in terms of coming in 1 month, putting in about $7 billion of money in equity. Having said that, now we have reached a level. I think today is the crucial day with respect to how the budget is going to be presented. If you look back in the last 3 weeks, there are a lot of areas where the macro factors, especially with respect to the inflation, still remain an area of concern, given the fact that high oil price globally is going to have an impact on the fuel price, as well as on import on fertilizers is again going to be costly. To that extent, if you look at it from the budget point of view, how the budget is going to drive the growth versus the expenditure, I think is going to be the factor I think we need to watch out. Having seen the yesterday's RBI policy where, contrary to the general expectation that they'll cut the rates in repo by about 20 basis points, they have not cut it, given the fact that everyone wants to actually watch as to how the fiscal situation for the country is going to be managed. Some of the bold steps which the government has taken in the last 1 or 2 days, I only hope that it doesn't get rolled back, especially with the railway fare hike. Definitely, I think is actually in the right direction, which indicates that there are policy measures the government is willing to take with respect to even the budget provisions. If some of them I think comes as a bold budget, then I'm sure some bit of a confidence will come back with respect to the recovery, which ultimately will lead to actually the money coming back to the equity market.
I want to get you in on this. Since it's liquidity chasing the market right now, give us one sector or stock that one should park their money in.
I think the way I think the last 1 year has panned out, and the way the interest rates environment has behaved. Clearly, I think the view is emerging that interest rate is it's peaking out. The interest rate is peaking out at the same time, having seen actually the last 3 years of the push has been largely driven by the consumptions. The time has come actually to push actually the infrastructure as a segment. If you have to get back to the balanced growth between the good revenue as well as the growth. So now my view is I think the infrastructure sectors could become probably the potentially driver actually of the growth, which has underperformed actually the market for the last 1.5 to 2 years. Maybe we could see actually the revival coming back, supported by the government initiative in terms of pushing actually investments into the infrastructures, including the private sector's investment that could come up. And second is supported by the low interest rate regime. I'm not saying low interest rate regime, the falling interest rate regime I think which could probably get reflected as we move forward in the rest of the calendar year.
One word answer before we wrap. After a 16% run up, are you bullish or are you cautiously bullish?
I think the broad market in our view could remain in a range. Given the fact
you're dodging my question.
I think the fact of the matter is we still need to catch up with respect to the corporate earnings actually coming back on track. If you look at this number on direct tax revenues itself, there has not been a significant growth. That reflects that the corporate earnings are not going to be significantly supportive of the equity market. At the same time, the interest rates bottoming out, rather peaking out, and the inflation is peaking out. At the same time, the policy measures are going to be more pro-investment oriented. We could see the confidence coming back in the second half of this year.